Hello, everyone. So welcome to the series, this first of a three-part series of webinars that we are providing. This first one is titled Preparing for Change, which is going to be talking about recent tax law updates and tax planning tips for physicians for this year and over the next several years. So welcome, everyone, to this presentation, and I would invite you to certainly tune in for the next two presentations that we have. Just real quick in the form of introductions, I'm David Auer, the owner of a firm, Providence CPAs. I also have Todd Hudgens on the call with us, and then Bill Bennett and Angie O'Day. So going back to today's agenda, I'm going to review a couple of things that became law starting back at the Secure Act 2.0 and at the end of 2022. So there were a couple of changes that impacted mostly around retirement planning. Our clients or taxpayers starting in 2023, a couple of things that are effective in 2024 and 2025 and then 2026. Next, I'm going to talk about some of the provisions, the key provisions of the Tax Cut and Jobs Act from 2017, and how those are going to be phased out or eliminated starting at the beginning of 2026, absent some act of Congress. The third part, which I think will be fairly interesting, is to go over what our current primary two presidential candidates are suggesting or proposing in the form of tax changes. And then the last is I have a case study where I went through on a presentation about 45 minutes long several months ago on comparing the tax planning of being a 1099 versus a W-2 independent or a 1099 independent contractor versus a W-2 employee. And in the chat, I have a link to that recording that I'll mention here again when we get to that slide. And then we'll open it up for questions, and hopefully we'll have some answers for you, and then talk about next steps. Just real quickly, as far as a disclaimer, everything we're going to talk about is, obviously within the four corners of the tax law. We're not going to be describing anything that is intended to get anyone in trouble, although we would recommend that if you do any tax planning, make sure you're talking to somebody that is an expert in the area of these tax laws that we're going to be talking about. And like I mentioned, we've got two next webinars coming up on July 25th and July 30th. So encourage you to register for those. So let's drill down again. This is going to be mostly review for those of you who attended our webinar earlier this year, but the Secure Act 2.0, which became effective at the end of 2022, had a couple of significant changes that were effective last year. I won't go into all of these in detail, but as you can read the list and as you'll get a copy of this recording afterwards, you can go through and see if there's any of these that may apply to you. But they were mostly in the area of changes in some of the retirement plan rules, a lot around increasing and more or less making it easier for taxpayers to be able to contribute to various Roth retirement accounts. So there's a little bit more flexibility than there was in the past in terms of taxpayers who want to fund with after-tax dollars into Roth accounts. And that becomes particularly important, especially because a high-income taxpayer generally can't contribute directly to a Roth IRA. However, they can do what is commonly described as a backdoor Roth IRA, which is merely I don't know how long this loophole will stay in existence, but basically it allows you to fund a traditional IRA and then convert that over to the Roth. There's a couple of issues you want to make sure you're aware of if you do something like that or convert to a Roth that may come back and trigger some unintended income tax consequences. So make sure you talk to somebody regarding how to do that properly. And again, any of us that are on the call, we can certainly address those questions as well. Anyway, so a lot of the things that were started last year obviously are going to continue being available into 2023 and or 2024 and beyond. Starting this year, there were a couple of changes that became effective. Again, most around dealing with retirement plans. So they lessened the rule about required minimum distributions, that they were no longer going to be applicable to if you had a Roth 401k or a Roth 403b. So especially for those clients who have accumulated quite a bit of their retirement savings in Roth 401ks or 403bs, that is good relief that you're not going to be required to take that money out, and you can let that continue to grow tax free. There is going to be some additional requirements, though, if you're over certain income limits, a highly paid employee, that any kind of catch-up contributions are going to be required to be treated as a Roth contribution, not a tax-deferred contribution. And then a little bit more flexibility in terms of access to some of your retirement funds if you need them for emergencies. And then also if you have accumulated money inside of a 529 plan that you no longer need for a child, it allows you to roll that money over gradually over to a Roth IRA, tax-free, as long as you haven't made any 529 contributions over the last 5 years. So it added a little bit of flexibility in it as it relates to 529 plans. Again, as you can see by some of these changes, Congress is trying to incentivize taxpayers to go ahead and make contributions to Roth. The policy reason there is obviously, that Congress gets to collect more income tax currently in exchange for giving up the ability to tax those distributions later that would otherwise come out of a tax deferred retirement account. Starting next year, a couple of additional changes pursuant to the Secure Act of 2.0. Catch-up provisions to 401ks and 403bs will increase to from 7,500 to 10,000, 5,000 for simple plans. However, only for taxpayers or investors who are age 60 through 63. So kind of curious why they cut that off at age 63, because you'd think the catch-up provisions should be available for those that are funding their retirement even later in life. But anyway, that's what the rule said. And so for those of you who are in that window, of 60 to 63, you have a little bit more of a catch-up provision allowed. And then there's a couple of different options or requirements now. If you do offer, if you're a small employer and you do have a retirement plan where you have to automatically enroll employees, although they can elect or they can opt out. But basically, the default rule is everyone is included unless they opt out. So again, a couple of changes that may impact those of you who either have 401ks or 403bs and or are employers offering those plans. And then and switching gears to talking about what are the provisions of the Tax Cut and Jobs Act of 2017 that are in the process of either being phased out or eliminated at the end of the year of next year, 2025. So as many of you may know, we have had a fairly generous depreciation provision called bonus depreciation that was created in the TCJA that allowed 100% expense deduction for qualifying equipment. That provision started phasing out in 2023. So last year it was 80%. This year 60. Next year's 40, and at the end of 2026, that'll be the last year that we have bonus depreciation of 20%. And then the big changes are going to happen January 1st of 2026, where right now the individual tax rates that were created as part of the act, being that the highest rate was 37%, those will expire, and now the top rate, which used to be 39.6%, will come back into existence. We will also have the increase in this. The standard deduction will go back to the original amount that had been in essence doubled from when it was prior to 2018. So that'll go back to the original amount. we have had over the last several years, we have not had a personal exemption allowance on a tax return. That will come back. However, that will then be phased out when income exceeds a certain amount. The child tax credit will go back to the original amount. And then probably a big item for a lot of our clients, especially those clients who live in states with income tax and or high property tax. We have been over the last several years, we have had your itemized deductions for state income and property tax has been capped at $10,000, $5,000 if you file single. That limit or that ceiling will go away, and then we'll be back to where you can deduct 100% of your state income tax or property tax if you itemize your deductions. The alternative minimum tax exemption will go back down to their previous amounts adjusted for inflation. That could be a surprise for a lot of people who may have been under the threshold of the alternative minimum tax exemption. That may now creep back up. That was a problem that existed prior to the TCJA Act, and that when they increased the exemption, that kept a lot of people that were in that middle range of taxable income out of having to pay that alternative tax. But that may now come back and be, become a more significant tax liability for a lot of our middle income clients. And unfortunately, sad to see this go, but we've been able to enjoy the benefit of having a 20% deduction on qualified business income for pass-through businesses. That will go away. And then the probably alarming for a lot of our clients that have been successful at accumulating wealth, and Todd will go into more detail on this on our next webinar on how to potentially address this, is the estate tax reduction amount will go back down. Right now, it's projected to be back to the $5 million amount adjusted for inflation. So we're estimating that could be somewhere between $6 and $7 million after it's adjusted for inflation. So that's going to bring back in, subject to an estate tax, a lot of our clients who have been below that higher threshold up to now. Excuse me. So probably a more interesting note, especially now that we're getting closer and closer to the election, is what is being proposed by the two primary, the Democratic and the Republican candidate for president. So some of these have been mentioned in the past, as far as several years ago at the last presidential election of what was being considered. We've been in an environment where this legislation has not been successful to get out of the House, but even though the Senate probably would have approved these changes. So depending on how the House and the Senate end up after this election and who gets elected president, just keep these top of mind as being possible over during the next president or next 4 years. So just looking specifically as it relates to individual income tax changes under President Biden, he's proposing an increase in the net investment income tax of from 3.8% to 5%. And for those clients who have significant W-2 income or business income, the surplus Medicare tax going from an additional tax of 0.9 to now 2.1%. The top income tax rate will go back to what it was prior to 2018, which is 39.6%. For incomes above 400,000 for those who file single, and 450,000 for joint filers. So that'll replace what now is generally speaking the 35% marginal bracket. So that'll be a jump of about 4.6% on top of the other, the potential in the Medicare surtax. And then for those clients, or for those taxpayers that are under the $400,000 amount, then Biden's proposal is to go ahead and let the Tax Cut and Jobs Act provisions stay in existence, but everything over that will be expiring. And then We don't have the details on this yet, but there'll be limited retirement account contributions for high-income taxpayers who already have a large IRA balance. I wasn't able to find any specific information on what constituted a large IRA balance, but I imagine the high-income taxpayers are again going to be that $400,000 amount, because that seems to be kind of the consistent definition of who's going to be subject to these higher tax rules. And then Section 1031 like-kind exchanges are going to be limited to $500,000 a gain. So that could impact a lot of people who own real estate or oil and gas interests. That may exceed that amount. They may need to start doing some of their exchanges this year while there's an unlimited amount that they can exchange. Under Trump, he will allow all of the provisions under the Tax Cut and Jobs Act remain permanent. So all of what currently is in existence will continue beyond and stay permanent for as long as the next candidate changes it. And then he's also proposing replacing some of the personal income taxes with increasing tariffs. So that'll be interesting to watch how that evolves. And then he has come out publicly and talked about how he's going to exempt tips from being subject to income tax, especially because that's a fairly large number of taxpayers who get tips income. So that could influence the amount of tax that they have to pay. As it relates to credits and deductions and exemptions, under Biden's proposal, he'll make the child tax credit fully refundable on a permanent basis. That's scheduled to expire. He'll increase the tax credit to $3,600 for young children and add an extra $3,000 for older children. That's usually children over the age of 17. He'll increase the earned income tax credit for workers without having qualifying children and make that on a permanent basis. And then he'll expand premium tax credits on a permanent basis. As it relates to credits, deductions, and exemptions, under Trump's proposal, he does not have any proposed changes. Another significant area that may be important as you do year-end tax planning this year is what the impact of capital gains or qualified dividend income may be. Under Biden's proposal, he would propose that long-term capital gains and qualified dividends would be taxed at ordinary rates, which at this income level would be the top rate of 39.6% for taxable income above $1 million. So no more lower tax rates for capital gains if your taxable income is over $1 million. And then he also proposes that he will tax for income tax purposes any unrealized capital gains at death above $5 million, $10 million for joint filers. So what this means is a client who has a fairly significant taxable estate may at the end of their lifetime be both subject to a capital gains tax, which again, if it's more than $1 million of taxable income, would be taxed at the highest ordinary tax rate of 39.6%, plus potentially be subject to an estate tax of 40%. So you can just imagine the significant erosion of a taxpayer's net worth if they have a significant amount of unrealized capital gains at death and they're above the exemption amount for estate tax purposes. So that'll significantly impact tax planning and estate planning for those clients. And then there'd be an effective tax rate, basically of 20% on all unrealized capital gains for households of net worths over $100 million. So again, this is going to be an income tax, but as those wealthy families have net worth that exceeds that 100 million, they will be paying a current income tax even on capital or gain or unrealized gains before they'd even have to even be selling that property. Under Trump, there are no changes proposed for the capital gains and qualified dividends. And then as it relates to corporate taxes, under Biden's proposal, the tax rate, which is right now a flat rate of 21%, federal rate, would go up to a flat rate of 28%. And he would expand the net investment income tax, which is that 3.8%, which is proposed to be 5%. to also apply to non-passive business income. So this could be a fairly significant change for compared to now, because net income from, for example, S corporations or partnerships is not currently from a business is not currently subject to a net investment income tax. So that could be a significant additional tax for those clients who have a sizable amount of income coming from those type of tax returns or taxable entities. Under Trump, he proposes to lower the rate 1% from 21% down to 20%. So not a big change on his side. Like I mentioned, this is I put in the chat if you'd like to watch a webinar, especially those of you who have or have the ability to convert from W-2 to 1099 income. This is a case study that I did several months ago where I compared in a self-employed physician situation what the difference in total tax would be if that physician was 1099 versus W-2, and what the various tax benefits could be. So that kind of wraps up the updates for now. There will be continuing to talk about tax updates as we go into the fall and as we get closer to the election. The goal of today was just to start the process of knowing what the changes that were getting ready to happen, and just so encourage anyone who these rules would impact to to start early rather than later, looking at tax planning alternatives, and just making sure you know what all of your options are. So real quick, if you haven't already been introduced to our firm, I know a lot of our clients are on this call. We have what we call our strategic wealth system, where we start all of our client engagements with a proactive tax plan focused on minimizing their tax burden as much as legally possible, helping them know where all of their financial life is, and or the situation, and knowing helping them control their money to the best way possible, and then have a plan to become financially independent as soon as possible. So if you haven't had a chance to read my latest book, The Richest Doctor, I talk about this model in there, and and it's a parable of four physicians as they go through through a journey on their pursuit of financial independence. The book is available on the richestdoctor.com website if you're interested in learning more about it. And then our process for those who have not worked with us, we start all of our new client relationships with what we call a strategic blueprint. That's basically a tax and a financial plan where we do a projection over the next 3 to 5 years, come up with as many options of how we might be able to reduce your tax liability over that time period, assuming you like what you see in that blueprint. We then have an onboarding, and we implement those tax strategies. And then probably our most important part of what we do is our year-end tax planning, which usually starting about this time of the year through the rest of the year is when we're focused on tax planning. So anyway, yeah, I'll just move on to this one. If you're interested in scheduling a introductory call, that you can scan this QR code, and also there'll be information or a link that you can schedule an initial introductory call with Angie, who's on our call today. So wave Angie if you want to say hi.
Hello.
And she'll be happy to kind of walk through whether you'll find out more about your situation and how we might be able to help you. So let's move to questions. Looks like Angie, do we have any questions in the?
So far, no questions. Everyone's being shy.
Okay. Well, I've kind of been dominating the talk, but Todd or Bill, do you have any questions?
Yeah, I've got one for you, David. I know one of the ones, whenever I'm working with clients and I talk a little bit about your tax minimization strategies and what you do for the physician space. A lot of times the clients ask me, well, what makes David and Provident so much different than who I've currently been using or who I've used for the past 5 years, 7 years, 10 years? What makes them so different or unique that makes them any different than any other CPA firm out there that works with physicians?
Well, that's a great question. Thanks, Bill. So yeah, so just basically bottom line is we focus very heavily on the tax planning piece. So the blue ocean or the niche that we found that to be in short supply out in the marketplace is having working with a CPA that understands your full financial situation, but then also looks through the windshield of where you're planning to go as far as from an income standpoint, and coming up with recommendations on how to reduce the potential income tax burden that you might face along the way. So we start, like I mentioned earlier, we start all of our new client engagements with a strategic blueprint where we have a chance to go through as many of those recommendations as possible that we think apply, and then do that over a multi-year process. And then we follow that up at the end of every year by refreshing that tax projection every year, because things do change and the law does change. So we're adding new things that may apply and taking old ones off the table. But anyway, that's probably the biggest distinction. We also, we have what I describe as kind of a menu of services that allows clients to pick and choose, what level of service they'd like to have. So we have what I describe as more of a subscription model, depending on what the client's needs are. So it's very predictable, very foreseeable on what we would provide at each of those levels and what the cost would be. We also calculate a return on investment, so the client can very easily see, how much this investment in order to save taxes is going to result back in their pocket. On average, over the last 4 years, as we've been tracking this, we have been successful at reducing our clients' tax liability by about 55%. So it's a little bit more than half. And the return on investment is usually anywhere from 15 to 30 times what the cost of realizing that tax savings is. So we find that creates a very successful model where our clients can measure tangibly what the benefit of working with us is. Again, we work on a month-to-month relationship, so if we don't achieve those results, the client isn't forced to use us in the future. So our goal is obviously to continue to produce those results year after year.
David, I do have a question from someone. They would like to know, how much do your services cost?
That's a great question, and I don't always, and it's very difficult to answer that. So the best way I can describe it is part of the reason why we call it a strategic blueprint is it's very much, I would say, like going to visit an architect to build a home or an office building. An architect's not going to be able to tell you what the cost of that building is going to be until they do the blueprint. So in our situation, the blueprint has a fee associated with it. It does come with a 10 times guarantee, which what that means is that if we can't save at least 10 times what that fee amount is in taxes in the very first year, although most of our tax planning or tax savings is year after year, we can't save that 10 times that amount in the first year, we'll refund that fee. And over 6 years of doing this, we've never had to refund that planning fee, because we have been successful at being able to save at least 10 times that amount. With that said, there's no strings attached. In the blueprint, we present the recommendations as well as the various costs of services. So generally, there's about 3 levels of services that clients have to pick from, and the list of strategies or recommendations varies fairly widely between from one client to another. So we can't really predict what that cost is going to be, until we have completed that blueprint. But anyway, like I mentioned, there's no strings attached. If we're not significantly creating a significant value of tax savings over whatever that investment is, the client's free to go find somebody else that can implement those recommendations. So obviously our hope is that doesn't happen. But anyway, we just can't predict what one particular what a particular client's total investment is going to be until we've gone through the blueprint process. All right. Any other questions? All 5 of us will be on the next 2 calls. So if questions come up between now and the next one, just write them down, and we'll be happy to address those questions, even though if they relate back to this webinar, and for that matter, any of the other 2 webinars. So again, I'll we'll ask one more time if there's any questions, and if not, I'll give everyone the benefit of time and again, thank you for attending today's webinar. If there's anything that we can do to help you reduce your tax liability, feel free to reach out and schedule a call with Angie, and we can schedule that. We can see if we can help you.
Oh, we do have a question, David. What is the benefit of a C Corp?
So it depends on the situation. C Corps have some utility depending on a client's a number of different factors. So for clients who otherwise might have a primary operating business that's taxed as an S corporation, or what is described as an S corporation, having a C corporation as an additional tax planning vehicle could provide certain benefits that just having an S corporation by itself doesn't provide. So really two primary benefits that the C corporation may have. One is in the form of fringe benefits. So there's about a dozen fringe benefits that C corporations can take advantage of that S corporations cannot. So a couple of those fringe benefits might include a medical expense reimbursement account, whereas the other alternative would be you have to itemize your medical expenses and exceed either 7.5% or 10% of your adjusted gross income. You might also be able to have a dependent care plan where you can reimburse yourself for dependent care expenses, and you might have either an educational assistance plan and or an employer athletic facility reimbursement plan that could also be a tax deductible expense to the C corporation, but considered tax-free to the shareholder. The other benefit of a C corporation could be in just the tax arbitrage of shifting income that otherwise would have flowed through an S corporation and be taxed at whatever the highest marginal rate is that the client has. Like I mentioned earlier, the C corporation tax rate right now is 21%. It was as low as 15% prior to the TCJA Act. So it even gave a little bit more of an arbitrage, but to the extent that you have additional cash flow that you plan to invest, it may be beneficial to move that extra cash flow from being taxed at a higher rate if it was an S corporation over to that lower tax fixed rate that a C corporation has. Again, an analysis needs to be made rather than just take for granted that a C corporation is always going to be better or beneficial in addition to an S corporation.
Piggybacking off of that, someone would like to know, do you not have to have wages to take advantage of the C Corp benefits?
You may, but you also may be able to aggregate W-2 income coming out of another related entity. You can aggregate the two entities. There's some tests you have to meet to be able to satisfy that. Good question. So again, not an easy question. Usually, most questions result in a "it depends" answer, but as a general rule, there's generally some ways to accommodate making sure that you can take advantage of both types of entities. So great. Well, I want to express our appreciation for everyone attending today, and you'll look forward to hopefully be receiving a copy of the recording here soon. And if we can be of any service, feel free to reach out to Angie and schedule an introductory call.
Thank you.
Thanks, everyone.
Bye, guys. Thank you.